This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast. Hello and welcome to another week of the Three Wise Monkeys podcast, a weekly podcast that's all about the markets and investing. My name's Andrew Page, founder of strawman.com, and today I'm joined by Mr. Claude Walker from ethicalequities.com.au. How you going, Claude?
I'm well, thanks. Hello, listeners.
It's only two wise monkeys this week.
Yes, that's right. Matt, the wisest of the monkeys, is over in New Zealand doing something he calls research.
The land of the long white cloud.
Yeah, but Andrew, if Matt's the wisest of the monkeys and I'm the youngest of the monkeys, what are you?
I'm the best looking of the monkeys.
Oh, so he
Can
claims.
I go with that?
Well, you know, we'll let it pass.
We'll let that one pass. Mate, what are we going to talk about today?
First on the agenda is Altium, which is obviously done really well.
Wow.
And there was some very bullish comments from the CEO around the most recent results. So you're going to run us through that.
Yep.
Then I'll touch on 1300 Smiles, which is a far less exciting business, but one that I like.
But
and
a
have
quiet
owned for years.
achiever.
Yeah, I think it's good. Anyway, so I'll touch on its results, which it released this morning.
Yep.
And then we're going to look at some of the other sort of broader results for companies that might tell us something about the more general economy and what developments are coming out of that.
Yeah, nice one. Yeah, we have had a few results this earnings season that sort of paint a bit of a picture there, and particularly there's been a few references to property, so I think that's worth digging into. But Altium. Now, before we start, mate, do you own any shares in Altium?
No, and I've actually never owned it, so I'm a real idiot for that. But, you know, if you don't own Altium shares, which are up, you know, good 20% or more today, don't feel bad. You're not the only one. I'm also missing out on the fun.
It's one of those things that it's for a while, it's sort of, you know, particularly the value investors amongst us, it looks very expensive, and it always does, and it continues to look that today. But I think that's cost you and I a lot of money.
Okay, but before we do our traditional waxing of lyrical about the share price movements, what does Altium do?
These guys generate software. Well, they do a few things actually, but the majority of their revenue comes from software that helps in the design of PCBs, printed circuit boards. So in this modern day and age, I think pretty much anything that has an electrical input will have a PCB inside of it. It's the brains of the device. And, you know, with the Internet of Things and just pretty much, you know, the technology of things, these things are ubiquitous and everywhere. And these guys have been around actually since about 1985, would you believe? And they've had a wild ride in that time. They were at 8 cents at one point about 15 odd years ago. So for those that are counting along at home, that's about a 450x return for anyone who had the foresight to buy it back then. But yeah, that's basically what they do. They've also got some parts divisions. They've got some other divisions as well. But that's basically what they're doing.
And so basically the meta theme here is that they can ride on the trend towards automation and having basically more electronics in everything. And they also have software, so it's sort of this sort of recurring revenue way of hitching a sale to that particular wind, which is, honestly, I can't believe I didn't buy it years ago.
This is what I was saying to you before, which is crazy, because when you go through the checkbox of things that we like to look for, it meets all of them. So, you know, capital light, check. Highly scalable, check. Super strong balance sheet, check. Massive amounts of recurring revenue, check. Huge long growth runway, check. And it's just sort of like it meets every possible criteria we have. It even gushes cash and pays a dividend despite very much being a growth company.
So why don't we own it? I mean, usually when Matt buys a stock, we think about buying it too.
I know Matt recommended it in the past. Does he own it as well?
I don't know what he owns right now.
I'll claim that. So here's the smart thing
I did.
I did recommend it at $4.50, and then I said, looks a little bit expensive. I think it was around 15 or so. So, you know, egg on face, well and truly. But yeah,
I remember we both liked it around $2. My problem was I think I put in an order, which then missed out on being filled by probably 20-30 cents at the time, which might have been about 10%.
Yeah.
And I thought, oh, bummer.
I've
missed it.
I just
oh my god, the most expensive thought to have had well, I should have just bid up, or at least to buy a smaller holding.
Yeah.
I don't know why I don't take my own advice. Usually, in this sort of situation, I say, if you'd like to own shares in a company, but it's just a little bit above the price you want to pay, then just slightly reduce your order size and buy some anyway.
Generally speaking, unless there's liquidity issues, I just do market orders. Like, frankly, if your investment thesis rests on the difference between 10 cents or something like that, or you're never going to be that precise. So for me, it's kind of like back. Let's say you did buy it at $2 and it turned out to be a terrible investment and it went to $1 eventually. Now whether you bought it at $2, $1.90, $2.10, really, what's the difference? And vice versa, if things happen to, as they have, gone very, very well also. But look,
anyway,
we digress.
Why is the share price up 20% today?
So let's put this in context too. This isn't a penny stock that's gone up 20%. This is a $4.3 something billion company that's gone up 20%. So
answer the question.
It's really amazing. So they had their results. They were really good. Revenue growth was 24%. So they have long stated this target. We want to be hitting 200 million US in revenue by 2020. On a trailing 12-month basis, they're about 155, 160 odd. So they're going to not only meet that target, I suspect they'll handily beat that target as well. So that's nice. I always like to see an ambitious target likely to be met and then exceeded. But it gets even better, Claude, my friend. The margin, the EBITDA margin that has been increasing steadily over the years, and they've been targeting about 35%. Well, they're already ahead of that, 36.7%. So that just reveals this lovely operating leverage in the business. In fact, the company came out today and they offered a new aspirational target. So for 2025, they are now saying that we want to be able to do US $500 million in revenue. But wait, there's more. We think we can be doing about 40% in terms of an EBITDA margin. 40%. Now, just to help put that into context, for a business that has been growing at pretty strong double-digit rates for a while, it's saying over the next 7 years or so, we think we can maintain 20% top-line growth. And you do the maths on that margin expansion as well. You're actually getting between the last full year's results and what they're saying they think they can do at 2025, close enough to 25% compound growth in annual profit over the next 7 years. So there's a lot more detail in all of that, but the market basically saw that and went, holy moly, buy.
Yeah, and I've watched this thing go up and up and up, not owning, and I've always thought, don't chase it, don't give in to fear of missing out. Is it time for me to just buy some and put myself out of my misery?
There's probably something to be said for doing the whole FOMO trade. It's just like, even if it's just like a tiny amount, just so you can feel good that you're at least on this trade.
But I'm in it to win it, man. I don't want to put a tiny amount on a thing just to feel good.
Well, I'm gonna give you my perspective, and I'm gonna say, before I say it, take this with a massive grain of salt, because I have long argued that as much as I love this company, and I do, I think it's one of the best on the ASX, I've never been able to get my head around the valuation. And despite that being, such a massive amount of egg on my face, I'm going to make that case again. So let me put some numbers.
The perpetually wrong case. Let us hear it again.
Maybe I'll be right eventually.
I've been wrong many times before, but here's what I think.
I did significantly increase my valuation, having done a bit of number crunching this morning. I think it's probably worth around 26.
Is that on Strawman?
It is on Strawman. Yeah, go check it out. $27 a share. But the price to sales on a trailing 12-month basis is about 20. It's pretty high. The PE is about 67. I think it's a real mistake to focus too much on PEs for fast-growing growth companies. And then there's a lot of, we both hold shares in Pro Medicus. Take a drink, listeners, which also has an eye-watering PE as well. But just to put that into context, I think a really good leveler here is to look at other wonderful companies, technology companies, and see how they're priced. And we've talked before about Google. Your US strategy is buy Google, which I think has a lot of merit to it. Google is growing its top line at about 20% last year. Well, its PE is 26, and it trades on a price to sales of a bit over 5.5 or so.
Yeah.
So again, they're different companies. There's different circumstances here.
Makes me want to buy more Google.
Do you know what I mean? That was my first thought as well. But so I'm in this funny zone of thinking I've been wrong before. I'm overthinking this, but I really struggle to make sense of it. So I try a thought exercise, and you say, let's assume they hit their 20 a 25 target. Let's assume that the margin is what they expect. And let's assume that the market maintains a very, very robust multiple at that point in time. You know, again, it's hard to do this in an audio environment, but again, you sort of run some numbers through, you make some assumptions on that, and I still think that could be potentially a situation where certainly you're not going to lose any money, but the average compound return for a shareholder might only be 6 or 7%, and that's not enough for me to get excited.
Not stacking up for you, but hey, you know, it's surprised to the upside before, so take everything Andrew says with a grain of salt.
Massive grain
Sorry,
of salt.
mate.
No, it's so true.
Yeah, look, I'm in the same boat. Looks like a really high quality company though, so it's definitely one that we'll keep following along. And if there's ever some sort of big market-wide sell-off, it might be one that you'd add to your shopping list.
I would argue, just quickly before we move on to, it's one of those ones that you could pretty much say is, you got to be careful when you use this term, but as close as recession-proof as you can probably get. Its exposure to the Aussie economy is very, very, very minimal. 58 million US cash in the bank, zero debt, huge amounts of free cash flow thrown off, lots of recurring revenue. So if Australia got into a bit of trouble, we might talk about this in just a moment, this is a business that share price might be impacted, but the fundamentals are not going to feel much.
Yeah, it's a global business. Anyway, it's a great. It's always good to see Australian companies succeed on a world stage. That's basically what we should be trying to do.
100%.
Okay. Moving on.
All right,
now,
what's next?
A less global business.
Okay.
Less exciting one. So, you know.
And by less global, you mean just not global?
Not at all global. Only in Australia and barely out of Queensland.
Yep.
So this is 1300 Smiles. It is a company that owns a bunch of dental clinics.
Okay.
It has dentists working in those clinics.
A dentist leading the company, I believe.
Yeah, indeed. Daryl Holmes, he's been the CEO and founder for its entire listed life.
Met him before, actually. Really genuine guy.
I think he's a very nice guy, and I enjoy his attitude to writing his regular company reports. He always has a little bit of discussion of policy matters that might interest him, which I think is quite funny, and I enjoyed his thoughts on the franking credit reforms in this particular report.
Nice.
But
we should talk about that actually next week. Let's make a reminder to do that.
Anyway, so the actual business is basically expanding into new dental practices. You then get dentists. You find hopefully the best dentists you can find that will work in those clinics. You share the revenue with them.
Is it a franchise model?
No, it's not a franchise model. They own the clinic, they own the brand, they own everything. They just have a dentist working in there.
So it's an employee arrangement.
It's not employee related.
Oh.
Well, there can be contractors. Okay. There are some employee dentists, but generally I think the preferred model is that they're contractors. They've got their business. They bring some clients themselves, but of course they're operating out of 1300 Smiles. 1300 Smiles allows those dentists to focus on being the best dentists they can be, building the relationship with those clients, which is all important. And they get remunerated in a way that sort of rewards them to do as much possible work, which is, of course, what 1300 Smiles wants, because they've got operating leverage in the business. If they've got a very full and busy clinic, they're going to make a lot more profit out of that than if the alternate were the case.
Okay.
So basically the good news is that the company put its best earnings per share performance this year ever. So they've managed to pip their high water mark from the first half of 2006. And then sort of before that, they had a very high first half in 2013. So there's almost a 3-year pattern there when they're putting in a new high. So that should give you an idea for the kind of level of growth we're seeing out of the business. It's modest. It heads in the right direction, but it's modest. The criticism you'd have of this results would be that it should have been higher growth because they've been doing acquisitions lately.
Gotcha.
And they're getting the full benefit of that.
So they're acquiring other dental practices.
Yeah. So basically the results sort of tend to imply that there's a bit of pressure on some of the existing clinics, given that they're adding in profits through new practices, but they aren't growing earnings per share particularly strongly. Having said that, there's also costs around running these acquisitions, and they're, according to the letter, they've been very busy working on a big acquisition that's coming up. So you might argue that there's probably been more acquisition related costs in the last couple of periods. To their credit, 1300 Smiles doesn't ask you to exclude those. That's just part of the ongoing business.
That is refreshing.
I think there's been sometimes they've reported in ways that was slightly less than ideal, but over the course of 10 years, I've been looking at these guys almost. They've really stood out for really doing the best they can by shareholders in terms of communicating with them and being fair and honest about what's going on with the business.
I get that real sense. Really shareholder friendly.
And, you know, they've done a great job in terms of outlining the situation in this report. I love to see that they are reporting on the over-the-counter revenue, because that talks about like basically the amount of demand they're servicing overall. Now, that also was a new high, which is great to see. Of course, again, benefiting from recent acquisitions. That's the other side of that particular coin.
So is it still a buy for you, or?
Yeah, look, it's still a buy. It's not sort of my bread and butter kind of stock, and it's not one that is necessarily right for everyone. But for me, it's one that I've been accumulating over the years, and I will continue to do so. I think there's a high likelihood that they can continue like growing earnings per share and dividends for a very, very long period of time.
What would you sort of suggest there? Is it sort of a mid upper single digit kind of rate if you were to sort of thumb stuck an average over the next sort of 5 years or so?
A mid rate. Like they increased the dividend by 4% in this half. Okay. So I think, something like that.
And the yield's about 4% or so now, fully franked.
So I'm forecasting a yield at current prices of just a tad over 4% fully franked.
Yep.
For me,
so that would suggest a reasonable price.
Well, yeah, so
certainly not expensive.
It doesn't seem overly expensive.
Maybe not super cheap either. But
the other thing to keep in mind is, so for me and other people who pay tax, these franking credits changes that seem quite likely to come in probably won't affect the value of franking credits. Mm-hmm. So if the dividends remain fully franked, that's like essentially equals pretty much a 5.7% yield for me.
Yep.
And given that I'm like more or less happy to sort of be stuck in the stock in terms of owning the capital for a very, very long time, just because I have confidence that Daryl Holmes wants to preserve the value of the company. Yep. He owns more than half of it.
Yep.
So I'm confident enough to leave my capital there. So look, it's capital that I can leave there for a long period of time. At the moment, it's paying me about 5.7%. I expect that to go up with time. Mm-hmm. We'll see what happens. It's probably not the most obvious screaming buy you've ever seen, but for me, I quite like having a little bit of my capital sitting there. I think it's a good company. I think it makes Australia have slightly cheaper dental care. It ticks a lot of the right boxes.
A lot of the ethical equities kind of stuff. In fact, have you got any content on ethical equities for this?
Not for these results. They've just come out, but
in terms
we've covered them in the past, and
okay.
I'll definitely do a write-up of these results, which will be on the website in due course.
Awesome. All right, man, let's round this off with a bit of a talk on the economy, property, and I thought it was interesting because, we are in the swing of sort of earnings season, and we've had some very interesting results. I guess what piqued my interest this week was Bingo. Do you follow Bingo at all? ASX code BIN? B-I-N?
Yeah, I absolutely have.
So these guys basically do waste management, right? These are the porta bins that they get dumped out the front of houses.
A pretty dirty industry too, if Four Corners is to be believed.
Yes, there is a bit of a seedy underbelly there. It would seem.
Yeah, it stinks almost.
But they didn't list. I don't believe it was all that long ago that they did list. They were previously sort of telling the market, because of various things, that they were on track sort of 15-20% operating profit growth. And then they came out and said, actually, we're going to be flat. And that was a fairly big drop from what they were saying. And what was particularly interesting was that they really blamed this on faster than expected softening. I love the word softening. Softening in multi-dwelling residential construction activity. So, in other words, it was another data point to suggest that, wow, construction is slowing. And I think we mentioned when we talked property recently, it's about 9.5% of all jobs in Australia is in the construction industry. So that was a very interesting data point. Shares fell 50%. Meanwhile, you've got another company, Automotive Holdings. These guys own car dealerships, a whole bunch of them.
Just before we go on to that disaster.
Stick with this disaster for the time being.
Just also I might notice on Bingo, they also said, they couldn't put a price rise through this year, which also suggests that they've maxed out pricing power. Yep. Probably less to do with economic conditions right now, that more to do with them having, tried to push it pretty hard, perhaps too hard before. And so, basically, I think that's probably changed the narrative around this company a fair bit.
You've got to wonder, again, I haven't done the work on it, but my my knee-jerk reaction is where's a competitive advantage for a company like this? From a customer's point of view, it's like, look, if you can just dump a bin out the front so I can chuck my stuff away.
But also,
that's all. I don't even care what happens to it, right? Just make it go away. Wouldn't imagine that you have a huge amount of pricing power, except for potentially you have some scale advantages. And I haven't read their prospectus, but no doubt that was a big argument for the consolidation.
Have you seen how like shiny and new a lot of their tracks look lately?
No.
Did you notice? Like, so after they listed, sort of like did rebranding, and then I'm pretty sure they've been investing in sort of giving the trucks a facelift and stuff. Either that, or they've been like buying new trucks. Because I think also it may have been a bit of a roll up. Like it had bought.
I want to again. I'm not sure,
it's
but
like
I want to say
rebranded all the tracks to Bingo and stuff like that. Like every time I see like a shiny bin truck, I'm like, is that branding there for the potential customers, or is it for the shareholders?
Yeah, right.
Anyway.
I do love the name though, by the way. I think it's a cool name.
Okay, on to
automotive. Well, again, so there was some interesting data points. Automotive holdings, obviously, cars are massively cyclical. They're the archetypal sort of cyclical kind of industry. And they were writing down a bunch of stuff from their balance sheet. Hey, but don't worry, Claude, non-cash. Okay. Don't have to worry about that.
Non-cash.
I'm being facetious.
So the cash went out the door years ago.
Do you know what's
the cash is not non-cash. It's like the cash is gone years ago. We can't even see the tail end of that cash.
We're just accepting.
Like we've completely lost track of where that's gone, and now we should probably admit it to you 3 or 4 years later.
Do you know what was even more hilarious with these guys is that they came out and sort of said, well, at the time when we made these acquisitions, the market was really, really strong, and so but now that the cycle has turned, that we just can't justify these carrying
values. Were they remunerated
values.
on EPS growth by any chance?
I don't know, but I probably
look it up from
But here's the thing, though. It's just like, what director / management of the most cyclical kind of industry on the planet buys something with the expectation that the cycle will never turn? Like, if you're having to write it down now, you are basically paying ridiculous prices for it to begin with. Anyway, that's a different aside. But what was interesting, of course, is they're talking about, quote unquote, the negative wealth effect from falling prices, and we've seen it with these guys, particularly in Perth for a while now.
What makes you so sure it's not them? Just they have a bad business and then they're blaming it on.
Oh, they've got bad businesses. The refrigeration logistics, a bit of a nightmare, and all the rest of it. But they did make special mention to Sydney and Melbourne. I was like, oh, that's another interesting data point. Call it confirmation bias if you like, one of the two. There was another very interesting data point in McGrath. So this is very direct, obviously, to property. What a disaster McGrath has been.
Are you sure it's a disaster? I think that John McGrath's done. Is that his name?
Yeah,
anyway, he's done an amazing job to sell it pretty much right at the top.
He timed that. He did that.
Disaster, mate. I think this was almost a work of art. So graceful. I think if I remember correctly, in its prospectus, they were sort of very clearly had in risks, the property market may go down. And indeed, they even somehow forecasted a little bit of softening.
Yeah. It's a masterclass, though, in extracting,
Yeah, and honestly, I feel like the transfer of wealth to the sellers is unfortunate, but the transfer of wealth away from the people that bought shares is entirely appropriate, because come on.
Yeah.
Who buys an IPO of a real estate company?
Oh my God. After what, a billion years of ridiculously high growth. Anyway.
It's like leveraged to the property market in this sort of crazy way, and then
massively
there were warning signs
obviously.
as well. Like they started losing
agents were walking out the door. They couldn't hang on to their agents.
You've got this absolute exodus. It's been nothing since bad news since it was sold.
They did some write downs. They built all this IT they spent $3.5 million on IT that turned out to be useless. That they've written down.
And look, I can get it if I can totally sympathize with value investors when they're looking at some sort of business and they're saying, surely all the bad news is priced in now. Surely it's all priced in now. Fair enough. But most value investors are also bearish on the property market.
Right.
So I just don't know why anyone would be looking for this this play.
Crazy. And I got to wonder too, do you reckon, I don't know, I do really doubt there's any brand value in here. Like when you're looking for an agent to sell your house, maybe the actual agent themselves have some brand if they've got a good reputation locally, but does the agency itself, I don't know. The shares are down 90% since they listed not that long ago. And so it wasn't. So obviously they're talking about weakness in the property market, but so not double whammy here. So sales volumes are falling and the prices are falling, so therefore commissions are falling as well. Absolute disaster. Despite all of that, I wouldn't go near it with a barge pole. I wouldn't buy it with your money. I reckon the net cash value, actually maybe not, just the cash value per share is about 9 cents. So maybe if it drops down to there, I might be interested.
Yeah, and if anyone else is interested in like losing money on real estate companies, Yellow Brick Road is also still trading on the stock exchange, now down to 7 cents.
Oh man, what a disaster that one's been as well.
Look, at some point, I guess, someone makes money out of these stocks because they get priced below the value of their assets, assuming you can get your hands on the assets.
It's cigar butt type investing,
yeah,
really,
look,
isn't it?
Exactly. So the Benjamin Graham people out there you go.
Yeah,
keep your eye on the
nerves of
property
steel
space.
for those guys. So look, there's a whole bunch of other examples. I thought one that was particularly interesting was car sales. So they had some results. So there's growth had slowed a little bit here, and again they were sort of talking to sort of weakness within the property market and the wealth effect there. So one of these things that was interesting. We get a lot of this data directly from the likes of domains and realestate.coms and all of this other kind of stuff. We know that property prices have been coming down, but it seems as though it's having, as you would expect, more of an impact in corporate earnings, and that's been more noise as being made about it. Of course, bear in mind here as well, it is a handy excuse, and I've got no doubt that plenty of retailers will be pointing towards it for companies that probably are not well run anyway. JB Hi-Fi, I notice, has bucked the trend of this, and so it's a good counter example here. But anyway, just an interesting topic.
Okay, but my 1-2 cents on that is the latest thing is property developers are offering to pay your mortgage payments for the first year. If that doesn't reek of desperation, I don't know what does.
Gosh.
So buckle up, ladies and gentlemen. It's definitely not stopping anytime soon.
Yeah.
We should definitely... God, I hope my bloody puts pay off one day.
Man, you got a strong thesis. The banks are the ones that will be interesting. I mean, they're the ones that are 38% of the market or something like that. When that starts to sort of roll through there, if it does, that's when it's going to really get very real.
On a broader level, it's not going to be fun if we fall into recession. But I just don't want to lose a lot of money on it.
Yeah.
And I want to be in a position to make money. So I am increasingly mentally preparing myself for that.
Yeah.
And
I
it's
think
looking more and more likely, at least we're going to a property price disinflation is happening.
We use the word softening. A softening.
Yeah, sure. A slight softening. Well, look, they've got a long way to come down. People think, 20% is a lot, but it just takes you back to levels that also still meant that, young Australians couldn't buy a house by the time they were, 35.
Yeah.
So I think that it could definitely fall more. But I mean, it's not so much, a nice house in a nice area is probably not so bad. It's just these flammable apartments that we've talked about before.
Flammable boxes in the sky.
Yeah, the flammable boxes in the sky.
Yeah.
I would not want to be owning them, and any sort of part of the economy that relies on the continuous construction and sale of those things is probably in trouble. And we might see a bit of this wealth effect stuff. But hey, look, also, we may find that government, especially if there's a change of government, Labor's known for liking to have the odd sort of big public spending program.
Yep.
Public spending program could be just what we need to sort of soften any impact from construction slowing down, and mining stays strong right now as well.
Yeah.
So
I think that's
it's not too
Australia's
bad.
done. That's been the story of Australia over recent decades, really. It's when troubles come along, there's something else that kind of softens the blow for us and picks up the slack.
The best thing that could happen is that the property prices get back down to much more affordable levels, because what that's going to do then is, first of all, there'll be a bit of intergenerational equity, but also, businesses have to pay rents or buy property in order to operate.
Yeah.
So having high property prices, it's this huge tax on activity, such as business activity.
Yeah.
And it just goes to sort of the landlords of this world.
You're going to say rent seekers then, weren't you?
Yeah, well, look, I mean, I actually am a landlord. Well, it would be a great thing longer term to have lower property prices much more in line with like sort of the average of the OECD versus incomes. I think it'll just be better for us as a society.
Yeah, there's definitely that dimension to it. I think if just for before we wrap up here, just for to be careful here in case we've put the fear of God into everyone and calling Armageddon and all of this kind of stuff.
I don't think anyone takes us that seriously.
I don't think, which is good. That's a very good starting point if you're listening to this podcast. But as you've mentioned before, as I and Matt have mentioned before, we're very much pretty much close to fully invested in the market. So it's not about sort of. I think here's the trouble with a lot of this stuff. There's a lot of smart, articulate people who have made a very bearish case for a very long time and have just been very wrong. So what's hard is the timing aspect of it. And so what we're certainly not saying here is sell everything and run to the hills. But it is very much having a very good think about the kind of companies you hold and the kind of exposures that they might have and how they may handle any kind of sluggishness, softness, if you will, in the wider economy.
It's definitely better to think about it in advance of a recession anyway, rather than once it's all happening.
100%. Listen, let's wrap it up there. Claude, thank you very much for your time.
Thanks, mate. It's been fun. And don't forget, we'll be covering as many earnings results as we can on ethical equities in the coming couple of weeks.
Nice.
And Andrew, will you be doing a guest post again for us?
Look, mate, yes.
Awesome, great. So I look forward to Andrew's take on Nanosonics.
Yes, I'll give you a good wrap up of Nanosonics, yes, for sure.
I know you own that one.
Remember to, if you like what we're doing and you want us to keep doing it, what really helps us is if you leave a nice rating and a few nice comments there, spread the word. It is very much appreciated. But until next week, my name's Andrew Page, and thanks for listening.
Thanks, guys.